If you spend enough time looking at Forex charts, you'll eventually start hunting for wedges. They're one of the most recognizable formations in trading, and for good reason. They often precede massive, sudden movements in price. The theory seems straightforward. As the price action gets squeezed between two converging lines, the tension builds. The assumption is that once the price breaks that boundary, all that pent-up energy will release in a profitable surge. But look at this chart. The price compresses, flashes a breakout, and triggers a buy signal. But instead of a surge of momentum, the price violently reverses, crashing straight back through the pattern and taking your stop loss with it. Zooming out reveals the trap. The breakout slammed directly into a massive pre-existing wall of resistance. Relying purely on the geometry of the wedge blinded us to the actual mechanical forces at play. Consistently surviving these setups requires moving past simple shape recognition. We have to decode the broader market context to separate the traps from the true momentum. This chart shows a rising wedge. Notice how both trend lines slope upward, but the lower support line is much steeper than the upper resistance line. Even though the price is making higher highs, the buyers are struggling to maintain their pace. The momentum is exhausting, which typically leads to a sharp bearish drop. Conversely, this chart shows a falling wedge. Here, the downward sloping lines are converging because the sellers are running out of steam. The upper resistance line is steeper, pushing the price down into a coiled spring that is primed for a bullish surge to the upside. Recognizing these two shapes is easy. The complexity, and the reason so many traders get burned, lies in their dual nature. A wedge can signal a complete trend reversal, or it can signal a brief continuation of the current trend. Context dictates the outcome. On the left of this split screen, a rising wedge forms at the peak of a long, exhausted uptrend, signaling a bearish reversal. On the right, a falling wedge forms at the bottom of a brutal downtrend, signaling a bullish reversal. Flip the context and the meaning changes. Now, the left side shows a falling wedge acting as a temporary pause during a massive uptrend, a bullish continuation. On the right, a rising wedge acts as a brief correction before the price resumes its steep descent. The internal geometry of the wedge is identical in both scenarios. The shape itself is largely meaningless until you analyze the dominant market trend that created it. Even with the right context, a breakout is just a possibility, not a guarantee. To avoid the traps we saw earlier, professional traders require strict validation signals before risking a single dollar. Look at the volume indicator below this wedge. As the price compresses toward the apex, the height of these vertical volume bars steadily decreases. This tells us exactly what we want to see. Market conviction is fading, and the current move is running on empty. When the true breakout finally happens, it must be accompanied by a massive surge in volume. This sudden spike confirms that heavy, institutional money is actually driving the move, rather than retail noise. We can also look for divergence using the Relative Strength Index, or RSI. RSI is a momentum indicator that measures the speed and magnitude of recent price changes to determine if an asset is overbought or oversold. This chart shows the price making a higher high inside the wedge, but directly below it, the RSI line is clearly making a lower high. The momentum is visibly exhausting itself before the price actually turns. A higher probability defense against a fakeout is patience. Instead of buying the exact moment the line is crossed, wait for the price to fall back and retest the broken trend line. When it touches that line and successfully bounces upward, the old resistance is confirmed as new support. Requiring decreasing volume during compression, a volume spike on the exit, and a successful retest strips guesswork out of the setup. It transforms a pure gamble into a calculated, high-probability execution. Once the trade is confirmed, survival depends on precise risk management. This chart shows a confirmed breakout and retest. The horizontal red line represents the stop loss, placed deliberately below the most recent swing low inside the wedge. This placement gives the trade enough breathing room to survive normal market noise without getting knocked out prematurely. To establish a logical take-profit target, we measure the vertical height of the wedge at its widest point, right where the pattern first began to form. We then take that exact vertical measurement and project it directly outward from the breakout point. This establishes a highly objective, mathematically sound profit target, keeping emotion entirely out of the exit strategy. A wedge pattern should never be traded in a vacuum. These strategies become exponentially more reliable when we look for confluence, when the wedge breakout perfectly aligns with the break of a major horizontal support or resistance level on the higher timeframes. Aligning multiple independent market signals causes the chaotic noise of the charts to snap into a clear, predictable system of execution. To avoid falling for false breakouts, you can start practicing these exact validation strategies, complete with advanced volume analysis and charting tools, on a free FXNX demo account today. Achieving a consistent market edge requires the patience to wait for undeniable structural confirmation before acting.